Hello friends, this is Victor here. Welcome back to the Intelligent Investor channel. In today's video, I'm going to analyze Alphabet or Google stock. I will talk about whether Google will be forced to break up into different companies because of all the antitrust cases against Google now. Also, I will talk about whether Google is undervalued now. As always, I would like to give you more context first. At the time of making this video, the S&P 500 has reached another all-time high thanks to the US Fed's recent 0.5% rate cuts. This is my prediction. I have said this many times in my previous videos. As long as the US economy is heading to a soft landing and not a hard landing, I expect that the S&P 500 will continue to reach new highs in the upcoming months because the US inflation is already heading toward the 2% inflation target. The Fed will continue lowering interest rates in the upcoming months. The job market is still fairly stable and strong. The US economy will continue to grow over time, and of course, the S&P 500 companies will continue to earn higher revenues and higher profits over time. But here's the interesting part. Even if the S&P 500 is near an all-time high again, there are still a few companies that are likely undervalued. Recently, Google stock has been down a lot mainly because the US and EU regulators have been filing antitrust cases against Google's search, Google's advertising business, and even the Play Store. The important part is that Google's fundamentals have not changed at all. In fact, the US and EU antitrust regulators are targeting all the big techs, including Apple, Amazon, Google, Meta, Microsoft, Qualcomm, and even Nvidia. The antitrust regulators are targeting Google the most right now because Google has the most services that are considered near monopolies. For example, Google Search, YouTube, Chrome web browser, Android OS, and its advertising business all have the biggest market shares compared to competitors. Of course, the best time to invest in Google is when there's a lot of fear in the market. For example, there was a large sell-off in the broader market back in 2022 and early 2023. I actually bought many Google shares during that time. Now, in recent weeks, Google has dipped a lot because many investors are concerned that the regulators may force Google to split into different companies. So in this video, I'm going to talk about whether Google will be forced to break up or if it will just need to pay large fines over the next several years. You will learn about these topics in this video. First, I will give you a quick stock portfolio update. Then I will talk about whether Google will break up, Google's financials, Google's long-term growth prospects, Google stock valuation, and whether I will buy more Google shares. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos every week that will help you become a great investor. Each video usually takes me 20 to 30 hours to make, so if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help all our members become multi-millionaires through investing. Once you become a premium member, you can follow all the stocks I'm investing in for the long term, follow my personal stock portfolios, and download the latest intrinsic valuation models for all the stocks I'm analyzing, so you will know when a stock becomes undervalued, fairly valued, or overvalued now. Also, you will have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. I mentioned this earlier. At the time of making this video, the S&P 500 has reached another all-time high because the US inflation is already heading to the 2% inflation target and because the Fed has started cutting rates again. But the Nasdaq 100 has not fully recovered yet. Many large cap tech stocks are still fairly valued or even undervalued now. I want to show you one of my portfolios so you will know my investing strategy over time. This portfolio is separated into 3 different accounts. In the first account, you can see that I have invested in many outstanding companies such as MasterCard, Microsoft, Visa, Amazon, TSMC, Google, Meta, and ASML. Many of them have become multi-bagger stocks because these outstanding companies continue to dominate in their markets. They are all new monopolies in their markets, and they continue to earn higher revenues and higher earnings over time. Here is an important investing lesson I've learned over the years. If you want to grow your portfolio substantially over time, you have to keep buying and holding the best companies. You have to keep buying them when they are undervalued. Also, you need to have the fortitude to hold them for many years, even if their stock prices can fluctuate a lot in the short term. This is the second account. This is the same story as the first account. I have several multi-bagger stocks in this account. Apple is already a 13-bagger in this account. Google, Visa, and Microsoft are also multi-baggers. I started investing in TSMC not too long ago and bought TSMC many times before. Now it's almost a 2-bagger stock. Earlier this year, I bought back many more Nvidia shares because I knew that Nvidia will continue dominating the AI server market. I also knew that Nvidia was greatly undervalued during the time. I sold some Apple shares this year, then I used the gains and bought more Amazon shares this year. This is the third account. This account is much newer than the 2 other accounts, so it will take longer for these companies to become multi-baggers. Just like the other accounts, I expect this account will also perform very well over the long term because I have invested in many outstanding companies that are near monopolies in their markets. For example, I have invested in TSMC, Nvidia, Microsoft, Meta, Amazon, ServiceNow, Google, AMD, Visa, Broadcom, Synopsys, Salesforce, and ASML. Speaking of Salesforce, I will likely sell Salesforce in the upcoming months once it recovers a lot. I want to use the funds to invest in other companies such as Nvidia, Google, and Microsoft that have much higher growth rates instead. Let's go back to Google. What are the biggest risks to consider? Many investors are concerned that the regulators may force Google to split into different companies because Google has a near monopoly in search and online advertising. Let me show you Google stats first, then I will explain why I believe the regulators will not force Google to split into different companies. First, Google has dominated the search engine market for many years already. When you think about search, you will think about Google first. At the time of making this video, Google has slightly over 90% of the search engine market. Microsoft Bing only has around 3.9% of the search market. This has been the trend for many years already. Microsoft has tried to compete with Google by releasing Bing with Copilot, but you can see Microsoft Bing with Copilot has not affected Google's search market share at all. Google still maintains around 90% of the search market. Google Chrome is the most popular web browser in the world. It has maintained over 60% of the market for many years already. The second most popular web browser is Apple's Safari, and the third most popular web browser is Microsoft Edge. Most users who do not use Mac, iPhone, or iPad will still choose Chrome over Microsoft Edge. And third, Google's Android OS is also a near monopoly in the mobile market. Typically, when you buy a smartphone, you only have 2 choices, either buy an iPhone or an Android phone. Here is the important part. Both iPhones and most Android phones use Google as their default search engine. This means Google essentially dominates the search market in both desktop computers and mobile devices. Here's the situation right now. Regulators are suing Google because they believe that Google has been using anti-competitive tactics to maintain its market dominance in search and online digital advertising. One of the biggest issues is that Google has been paying Apple around $20 billion each year, so Google can be the default search engine on iPhone, iPad, and Mac. $20 billion is essentially free revenue for Apple each year. Google pays billions to Samsung to use Google as the default search engine on Samsung smartphones. Google also pays millions to other competing web browsers such as Mozilla Firefox and Opera to use Google as the default search engine. Here is the important part you should know. If the regulators do not allow Google to have exclusive contracts with Apple and Samsung to use Google as the default search engine, Apple and Samsung will not be happy because they will likely earn much less ad revenues from Google each year. Google can generate much more ad revenues for Apple and Samsung each year compared to Microsoft Bing because most people use Google to search for things online. This is my prediction. Going forward, instead of having Google be the default search engine on all our smartphones and mobile devices, I think users will be prompt to choose their default search engine whenever they buy a new iPhone, a new Mac, a new iPad, or a new Android phone, or whenever users download a web browser other than Chrome. If this happens, I believe most users will still choose Google over Bing as their default search engine because most users are used to using Google to search for things online. Google tends to give the best and fastest answers to user queries compared to Bing and other search engines. More importantly, most users are used to the Google ecosystem. Google's ecosystem includes many very popular services such as Google Search, YouTube, Gmail, Chrome, Google Map, Android OS, Play Store, Google Gemini, and many other Google apps. Once you are used to Google's ecosystem, it is very hard to switch to another search engine such as Microsoft Bing. It is nearly impossible to replace Google because Google Search is well interconnected with other apps and services. This is why most users will still choose Google as their default search engine. Here is another thing we should consider. The antitrust regulators have sued Google before. The US and EU regulators have been working on cases against Google for many years already. In fact, the antitrust regulators have already fined Google over $8 billion over the last 10 years. So all these antitrust cases are not new at all. Also, all these antitrust cases take many years to settle. I mentioned this earlier, regulators are essentially targeting all the big techs because these big techs such as Apple, Google, Microsoft, Amazon, Meta, and even Nvidia are near monopolies in their markets. Google just has the most services that are near monopolies. Let's take a look at the antitrust case from 25 years ago. The Department of Justice (DOJ) versus Microsoft case is the closest antitrust case, similar to the current antitrust cases against Google. I believe this case suggests that the regulators will not force Google to split into different companies. Instead, Google will likely need to pay billions of dollars to settle these cases. Also, Google will likely need to change its business practices. This is what happened in the DOJ versus Microsoft case from 25 years ago. The DOJ found that Microsoft was abusing its monopoly in the PC operating systems market. Microsoft was bundling its Internet Explorer web browser with Windows. Microsoft also used contracts to force PC makers to include Internet Explorer with Windows. This made it impossible for other web browsers, such as Netscape, to compete with Internet Explorer. In the end, as you may already know, Internet Explorer dominated the entire web browser market and replaced Netscape during that time. Here's the important part. Initially, the court wanted Microsoft to break up into two different companies. One company for the Windows OS and the other company for software applications. Of course, Microsoft appealed to the court's breakup order. In the end, the antitrust case was settled between the DOJ and Microsoft. Microsoft did not need to break up into two different companies. Instead, Microsoft had to stop its anti-competitive agreements with PC manufacturers. Microsoft had to provide APIs to third-party developers so third-party developers could make software that would work very well on Windows. This has allowed competitors to make much better and more optimized apps on Windows. While Microsoft did not get fined in the DOJ versus Microsoft case, Microsoft was fined billions of dollars from other similar antitrust cases in Europe. I believe this case is very similar to what's happening to Google now. I believe the regulators will fine Google billions of dollars over the next several years. It takes many years for these cases to settle. More importantly, instead of forcing Google to break up its businesses, I believe the regulators will force Google to end its exclusive contracts with Apple and Samsung, and let end users choose their default search engine. If this happens, I believe most users will still choose Google as their default search engine because most users are used to the Google ecosystem, which includes Google Search, YouTube, Chrome, Android OS, and many other Google services. Other than search, regulators are also targeting Google's advertising business, specifically its advertising technology platform or AdTech. This AdTech antitrust case will affect Google more because advertising contributes about 76% of Google's total revenues every year. Specifically, this AdTech antitrust case is targeting Google Network business the most. Google Network contributes about 8% to 9% of Google's total revenues every year. Google Network earns ad revenues from third-party websites and apps that use Google to sell ad space to advertisers. Google's most important services are Google Search and YouTube. Google Search and YouTube contribute the most revenue, or about 67% of Google's total revenues every year. Here is the situation right now. Regulators want to split Google's AdTech business because Google controls all three aspects of online advertising. The supply side from publishers, such as websites and apps, who want to sell their ad space to advertisers. The demand side from advertisers, who want to buy ad space and target the right customers. And in the middle, the ad exchange that allows real-time bidding of ads. The ad exchange is very similar to a stock exchange. According to this Associated Press article, publishers naturally want to receive as high a price as possible for their ad space, but testimony at trial has shown that didn't always happen due to the rules Google imposed. For years, Google gave its ad exchange the first chance to match a publisher's proposed floor price. For instance, if a publisher wanted to sell a specific ad impression for a minimum of 50 cents, Google software would give its own ad exchange the first chance to purchase. If Google's ad exchange bid 50 cents, it will win the auction, even if competing ad exchange down the line were willing to pay more. Google's response relied on its control of all three components of the process. If publishers conducted an auction outside Google's purview, but they still use Google's publisher ad server, that software forced the winning bid back into Google's ad exchange. If Google was willing to match the price that publishers had received under the header bidding auction, Google would win the auction. Here's the important part that explains why large publishers are not willing to leave Google's advertising platform. Publishers could stop using Google's ad exchange entirely, but at trial said they were reluctant to do so because then they would also lose access to Google's huge exclusive cache of advertisers in its Google Ads network, which was only available through Google's ad exchange. According to Reuters, Google tried to sell its ad exchange platform in order to settle with the EU publishers, but the EU publishers rejected the proposal because they believed that Google selling its ad exchange platform was not enough. The Commission is unlikely to force Google to divest assets for now, but may instead order it to stop its alleged anti-competitive practices in the coming months because of the complexity of the case. I do not believe Google is willing to sell its ad exchange platform to settle this case because Google's ad exchange is a very important business. It does not make sense for Google to sell a very profitable and important business. Typically, big techs that dominate their markets do not sell their assets, especially their most profitable businesses. Like other big techs, Google is willing to pay large fines and change its business practices in order to comply with regulations. I believe the regulators will not force Google to split into different companies because of several main reasons. First, it is extremely complicated to split Google into different companies. All these services such as Google Search, YouTube, Chrome, Android OS, Google Drive, Google Cloud, Ad Exchange, AdMob for apps, AdSense for publishers, Google Ads, and Google Ad Manager for advertisers are all very well integrated with each other. They are a part of Google's ecosystem. They all share a lot of data, algorithms, and resources with each other. Many of these services will not work well if you break them into different businesses. Just imagine separating iOS from Apple's iPhone. It will not work at all. Second, there's a tech war or a chip war between the US and China. This tech war will last for many years. Both countries want to be the dominant leader in AI and advanced chip manufacturing. The US wants to be the leader in AI, advanced chip manufacturing, chip design, mobile computing, high-performance computing, cloud computing, and many leading-edge tech. Google is one of the leaders in AI and cloud computing, and of course, Google is the market leader in search and online advertising. It will not make sense for the US and its European allies to break up Google's businesses. Doing so will make Google less competitive in AI research and development. It is in the US best interest to allow Google and the other big techs such as Nvidia, Apple, Microsoft, Amazon, and Meta to continue dominating in AI, high-performance computing, cloud computing, and other leading-edge technologies. Typically, the US and EU antitrust regulators don't break up existing US companies, such as the big techs, that have already achieved market dominance in their markets. Typically, these antitrust regulators tend to find companies that have anti-competitive behaviors. These regulators tend to force companies to change their anti-competitive practices to allow more competition in the market. Third, Google can show the antitrust regulators that the company is already facing a lot of competition from Meta, Amazon, and now OpenAI. For example, OpenAI is planning to release its search engine powered by GPT models to compete with Google. Many investors think that OpenAI's upcoming search engine may be able to disrupt Google's search business. So if we consider all these things and more competition from Meta, Amazon, and OpenAI, I believe the US and EU regulators will not force Google to break up. Instead, I believe the regulators will make Google change its business practices to allow more competition in search and online advertising going forward. Of course, the US regulators will still fine Google billions of dollars over the next several years. Also, all these antitrust cases will take many years to settle. I want to show you Google's most recent financials. It shows that Google has a very strong balance sheet. It also shows that Google has enough cash set aside to pay for all these antitrust fines over the next decade. According to the most recent quarter, Google had $100 billion in cash equivalents and marketable securities. In comparison, Google had around $25 billion in long-term debt and operating lease liabilities. This means Google can pay off all its long-term debt and operating lease liabilities in advance and still have around $75 billion in cash left. In terms of financials, you can see that Google has had very strong revenue growth, operating income growth, and free cash flow growth over the past 10 years. Google also had a fairly high free cash flow margin over the past 10 years. However, starting this year, Google's free cash flow margin has decreased slightly compared to previous years because Google has been spending a lot of money on AI infrastructure in recent quarters. Google expects to continue increasing its investment in AI infrastructure in the upcoming quarters. This means Google's free cash flow margin will likely remain lower over the next 2 to 3 years. Let's talk about Google's long-term growth prospects so you will know Google's biggest growth opportunities over the next 5 to 10 years. Google has 3 main revenue sources. First, advertising will continue to be Google's biggest revenue source. Typically, Google advertising contributes about 76% of the company's total revenues every year. The second biggest revenue driver is Google's subscription services, platforms, and devices. This includes subscription revenues from YouTube Premium, YouTube Music, and Google One Bundle, as well as sales of Android apps and in-app purchase. The third biggest revenue driver is Google's cloud computing business, Google Cloud. This is my prediction. Going forward, advertising will still be Google's biggest revenue source, but Google's advertising business is already very mature. I believe Google's advertising business will grow at a high single-digit rate or around 10% each year over the longer term. Google's biggest growth opportunities will be subscription services and Google Cloud. As you may already know, YouTube is the second largest search engine in the world, right behind Google Search. When you want to search for videos online, you will likely use YouTube first. At the time of making this video, over 2.7 billion active users are using YouTube every month. YouTube will continue to grow because more people are cutting their cables and watching videos online. People are spending more time watching YouTube because YouTube has the most video content and the most video creators. YouTube is also free. It's nearly impossible for another video streaming platform to compete with YouTube. Here's the important part. YouTube Premium has grown a lot since 2015. As of now, YouTube Premium has over 100 million premium subscribers. In comparison, over 2.7 billion users use YouTube every month. This shows that YouTube Premium still has a lot of room to grow. Similar to Netflix, I believe YouTube Premium will continue to grow substantially over time and contribute a lot of subscription revenues to Google every year because many subscribers like myself don't like to watch ads. Moreover, many people subscribe to YouTube Premium because they want to download videos to watch offline. They want to play YouTube videos while they're using other apps, or they want to listen to YouTube while their phone screens are off. I believe all these premium features will help grow YouTube Premium substantially over time. Here is another service that will help Google grow its subscription revenues over time. At the time of making this video, Google is offering several Google One subscription plans that include all these cloud services and extra storage. Recently, Google has started the AI Premium plan that bundles the latest Gemini large language model with all the standard cloud services and extra storage. I believe this bundling subscription plan gives Google a very large competitive advantage over OpenAI, Anthropic, and other AI companies because other AI companies' subscription plans do not include extra cloud storage and other essential cloud services like Google. Typically, if you use Google Drive, Google Photos, and other Google Cloud services a lot, and if you want to use Google's latest AI models, you will likely subscribe to Google's AI Premium plan, and the cost is almost the same as other AI company subscription plans. This is my prediction. In the future, as Google's AI models become much more advanced, I believe many users will subscribe to Google's AI Premium plan because it also includes the standard Google Cloud and storage services. Here is one of Google's biggest competitive advantage. Building the best AI model is extremely expensive. Not many companies in the world can afford to build their large language models or LLMs that have billions of parameters or even trillions of parameters. For example, Sam Altman stated that it costs over $100 million just to train GPT-4. But if you want to build the next frontier AI model, it will cost at least several $billion. Larry Ellison, the co-founder of Oracle, said this. The entry price for a real frontier AI model from someone who wants to compete in the area is about $100 billion. Let me repeat, around $100 billion. That's over the next 4 or 5 years for anyone who wants to play in that game. That's a lot of money, and it doesn't get easier. Let's consider this. If you want to become the leader in AI and have the best AI models that are also the most accurate, you will need these 4 things. The most AI compute, the best AI models with trillions of parameters, a very large amount of data that is needed to train AI models, and of course, billions of dollars to invest in AI each year. Very few companies in the world can invest billions of dollars in AI each year. Also, very few companies in the world have the most data that is needed to train AI models. In fact, Google is one of the few companies that have the most AI compute, some of the most advanced AI models, a large amount of data, and a lot of capital to invest in AI each year. Right now, all the major tech companies are racing to develop the next-gen frontier AI models. Whoever develops the next-gen frontier AI models first will be able to establish leadership in their markets. All these frontier AI models need a large amount of data for training. Google is one of the few companies that have the data required to train the most advanced AI models. Going forward, I believe Google's cloud computing business will be the company's biggest growth driver because we're still at the beginning of the current AI revolution. Similar to the internet revolution, I believe the current AI revolution will last for many years. Now, there's a very large demand for the most advanced AI models and the best and most energy efficient AI systems that are needed to train and infer AI models. The current LLMs, the next frontier AI models, and eventually the artificial general intelligence (AI) models will need a lot more AI compute that's very performant and energy efficient going forward. Only the largest enterprises and the largest cloud providers such as Amazon, Microsoft, Google, and Oracle can afford to build large AI data centers with hundreds of thousands of AI GPUs that are needed to train and infer LLMs and the next frontier AI models. It's very important to understand this because most AI startups and AI companies cannot afford to buy the best AI GPUs and AI systems from NVIDIA and AMD, so they will need to rent AI GPUs from the largest cloud providers such as Amazon, Microsoft, Google, and Oracle. For example, NVIDIA's upcoming fully loaded Blackwell GB200 NVL72 server system can cost around $3 million each. And you need thousands of AI GPUs to train and infer AI models. This means AI companies will have no choice but to rent AI GPUs from the largest cloud providers that have access to the most advanced AI GPUs from NVIDIA and AMD. This will drive more cloud consumption runnings for Google going forward. I want to share this interview with you. It explains that cloud providers such as Google can earn around $5 to $7 over several years for every dollar that they spend on buying a GPU from NVIDIA. One way to earn ROI right away is to provide GPU rentals to AI startups and AI companies that need to train their AI models. The second way to earn ROI is to serve tokens for AI inferencing. Ian Buck from NVIDIA said this.
One, of course, is infrastructure. Providing infrastructure at scale for the world's AI startups and community in the cloud to go consume. And you see all the major startups partnering or getting access to the technology, often not just one, but multiple. or they switch and move around to figure out who can help them scale and grow their capabilities, or who's bringing the GPU market first to where can they get their GPUs. That's infrastructure. And of course, infrastructure is hugely profitable. Every dollar a cloud provider spends on buying a GPU, they're going to make it back at $5 over 4 years. The second thing we're seeing is growth in token serving, just building and providing AI inference, whether it be a Llama or a Mistral or a Gemma, and providing it to the community's users to serve tokens. Here the economics are even better. It's every dollar spent is $7 earned over that same time period and growing.
Let me show you this cloud spending forecast from Gartner. According to Gartner, Cloud Infrastructure as a Service, or IaaS, is expected to grow by around 25.6% in 2024 and 29% in 2025. Cloud Platform as a Service, or PaaS, is expected to grow by around 20.6% in 2024 and 22.7% in 2025. Of course, AI is one of the biggest growth drivers of cloud spending. There are two secular trends that will continue to benefit Google's cloud computing business going forward. First, more companies will move their IT infrastructure and workloads to the cloud. And second, as I mentioned earlier, many AI startups and AI companies will need to rent AI compute from Google and other cloud providers going forward. Here's a longer-term forecast from IDC. According to IDC, worldwide spending on public cloud services is expected to double between 2024 and 2028. This represents a 5-year compound annual growth, or CAGR, of 19.4% between 2024 and 2028. All these forecasts from Gartner and IDC suggest that worldwide cloud spending, especially IaaS and PaaS, is not going to slow down over the next several years. In fact, worldwide cloud spending will likely accelerate more over the next several years because of the current AI revolution. And of course, more companies will need to move their traditional IT workloads to the cloud. This is from the most recent earnings call. Google CEO stated that the risk of underinvesting in AI is much higher than overinvesting in AI. This suggests that Google will continue to increase its investments in AI infrastructure and custom AI chips with Broadcom over the next several years. This means Google's free cash flow margin will likely drop slightly over the next 2 to 3 years. Google CEO said this.
Obviously, we are, at an early stage of what I view as a, very transformative area. And in technology, when you are going through these transitions, aggressively investing upfront in a defining category, particularly in an area in which, in a leveraged way, cuts across all our core areas, our products, including search, YouTube, and other services, as well as fuels growth in cloud and supports the innovative long-term bets and other bets. Is definitely something for us makes sense to lean in. I think the one way I think about it is when you go through a curve like this, the risk of underinvesting is dramatically greater than the risk of overinvesting for us here. Even in scenarios where, if it turns out that we are overinvesting, these are infrastructure which are widely useful for us. They have long, useful lives, and we can apply it across, and we can work through that. But I think, not investing to be at the frontier, I think, definitely has a much more significant downside.
Let me show you these consensus estimates from Second Alpha. In terms of revenue forecast, Google's revenue is expected to grow by around 13% this year. Over the next several years, Google's revenue is expected to grow by around 9% to 11% each year. In terms of EPS estimates, Google's EPS is expected to increase by around 32% this year. After that, Google's EPS is expected to grow by around 15% each year over the next several years. I think these EPS growth rates are reasonable because Google will likely buy back more shares going forward, which will reduce the number of shares outstanding and increase the EPS growth rates. Let's take a look at Google's forward PE so you will know where the Google stock is likely undervalued now. At the time of making this video, Google's forward PE this year is at around 21, which is very low for a mega cap growth company. Next year, Google's forward PE is expected to drop to around 19, which is even lower. These 4 P's suggest that Google is likely undervalued now. Let me show you this intrinsic valuation model here. I always use this intrinsic valuation model to calculate each stock's intrinsic value. You can use it to calculate Google's intrinsic value, so you will know when Google stock becomes undervalued, fairly valued, or overvalued. If you want this intrinsic valuation model, you can download it from my Patreon blog. The link is in the video description. These are the key assumptions in this calculator. First, I define Google's intrinsic value as its future free cash flows discounted to the present day. I use the discount rate of 10% here. You can use a higher discount rate here if you want to be more conservative. Based on the biggest risk and the long-term growth prospects I talked about earlier, I believe Google's revenue will grow at a compound annual growth rate or CAGR between 10% and 12% each year over the next several years. This is very close to the consensus revenue estimates. I used a long-term growth rate of 6.5% to calculate the terminal value. This is very conservative for a big tech growth company. Of course, if you want to be more conservative, you can use a lower long-term growth rate to calculate the terminal value. Over the next several years, I'm assuming Google's free cash flow margin will still be lower than the previous 3 years because Google is planning to spend a large amount of capex on AI infrastructure each year. However, I believe Google's free cash flow margin will improve gradually over the long term. Let's go over these 3 case scenarios: worst case, normal case, and best case scenarios. Under the worst case scenario, we're forecasting that Google's revenue will grow at a CAGR of 10% each year over the next several years. Then Google's intrinsic value should be around $2.5 trillion for the entire company, or $200 per share. I'm giving this scenario a 25% probability here. Under the base case scenario, we're forecasting that Google's revenue will grow at a CAGR of 11% each year over the next several years. Then Google's intrinsic value should be around $2.6 trillion for the entire company, or $208 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we're forecasting that Google's revenue will grow at a CAGR of 12% each year over the next several years. Then Google's intrinsic value should be around $2.7 trillion for the entire company, or $217 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, Google's intrinsic value should be around $208 per share. I also use a forward sales valuation model to estimate Google's intrinsic value, which should be around $1.98 trillion for the entire company, or around $159 per share. If we take the average of both valuation models, I believe Google's intrinsic value should be around $184 per share. In comparison, Morningstar has given Google a slightly higher fair value of $209 per share. Let me show you this preview. Right now, I'm developing an application with a business partner. Our goal is to create the best investing software that can help investors analyze stocks, find the best stocks, and calculate each stock's intrinsic value. Again, this application is in beta. This screenshot is a preview. The orange line represents Google's fair value, and the blue line is Google's stock price. Here, you can see that Google stock has dropped below its fair value line in recent weeks. All these valuation models and tools suggest that Google stock is likely undervalued now. So will I buy Google stock? Yes, I will likely buy more shares of Google over time, as long as Google is still an outstanding business and is still undervalued below its intrinsic value. First, I believe the antitrust regulators will not force Google to split into different companies. There are many reasons. Google services such as Google Search, Chrome, YouTube, Android OS, and AdTech are very well integrated with each other. Breaking them into separate companies is nearly impossible because they all need each other to work. Right now, there's a tech war or a chip war between the US and China. The US wants to be the leader in AI, semiconductor design, and advanced chip manufacturing. It is in the US best interest to make sure US companies continue to be the market leader in AI, high-performance computing, cloud computing, and other leading-edge tech. Google is one of the leaders in AI, so it will not make sense for the US and its European allies to break Google into different companies. This is my prediction. Similar to the DOJ versus Microsoft case, I believe the antitrust regulators will make Google pay billions of dollars in fines and make Google change its business practices so that other companies can compete better in online advertising and search. Going forward, other than search and online advertising, I believe Google has the biggest growth opportunities in subscription services and cloud computing business. I believe Google will continue to be one of the market leaders in AI, specifically the next-gen frontier AI models. Google has one of the most AI compute, some of the best AI models, the most data that is needed to train AI models, and of course, a lot of capital to invest in AI every year. Now, all these are only my opinions and my analysis based on my research. They are not financial wise. There are always risks associated with investing. It's very important to invest in what you know and not speculate. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.